Welcome to the Westside Investors Network, WIN, your community of investing knowledge for growth. This is the Real Estate Professionals Investing Podcast for real estate professionals by real estate professionals. This show is focused on the next step in your career, investing. Thank you for listening. And please, if you like our content, rate us on your podcast provider. Just a quick disclaimer, the views and opinions expressed in this podcast are for educational purposes only and should not be construed as an offer to buy or sell any shares or securities, make or consider any investments, or take any other action.
Welcome back to another episode of the Deal Deep Dive segment on the Westside Investors Network podcast. I'm your host, Trent Werner. In this segment, our featured guests will share their unique stories on a specific deal they've invested in. We will dive deep into finding the deal, financing the deal, writing an offer, and the due diligence. Do us a solid and smash that subscribe button, leave us a rating, and share this episode. And now, let's dive deep. Welcome back to the Westside Investors Network podcast. I'm your host, Trent Werner. On today's episode, we're joined by Dave Seymour of Freedom Venture Investments. Dave's going to share his story about how he turned a 16-year firefighting career into a wholesaling and house flipping business that has now catapulted into a large multifamily syndication that focuses on development. We're also going to hear about how Dave's career as a firefighter has transitioned into his real estate career and the skills that he took from his previous life into the current one. Now let's welcome Dave Seymour. All right, Dave Seymour joining us today. Dave, thanks so much for taking the time to chat with us.
Yeah, Trent, I appreciate it, man. Let's get down and dirty, as we say. I'm into it, man. Whatever you need, let's go.
Well, Dave, I know you weren't in real estate for your entire career. I do think it would be interesting for our listeners to hear how you went from something completely not unrelated to real estate and then got into real estate. So what'd you do prior to becoming a big time real estate investor?
Yeah, look, man, I followed the formula that was given to me by my father, right? Which was, I'm from a working class background in the East End of London. And, I was always told as a kid, you just work hard, right? You trade your time for somebody else's money. Then with a set of circumstances, I immigrated to the States. I was a young gun. I was only 20 years old, following my the love of my life at the time, who was an American. So I followed her all the way to the other side of the world. And a friend of mine said to me, he said, why don't you get one of those good government jobs, Dave? And I'm like, what are you talking about? And I started testing for, a couple of different government positions. I was always attracted to the camaraderie of police work and firefighting. And, I was blessed in 1997. I was hired onto the Lynn Fire Department here in Massachusetts. I live just north of Boston. And, I spent 16 years in that career, man. And I freaking loved it. I did, brother. I tell you, there's something about, the rush, obviously. You've got to be a little bit broken upstairs to do that kind of work, right? But a lot of the parallels from firefighting, are applicable in real estate investing today, and we'll unpack that in a minute. But yeah, 16 years in the fire department, and I worked construction on my days off, as most firefighters do. A little plug to your local fire department if you need a plumber, an electrician, a GC, a deck man, a brickie, a bookie, not a bookie. If you need any of those careers or services, give the guys at the firehouse a shout. But I work construction on my days off, and it was that exposure to the construction world that eventually led me over to real estate. So that was kind of the transition. But firefighting was awesome, man. I was paramedic in a city. If you're going to do the job, do the job. Don't be a looky-loo. You know what I mean? Don't be on the outside looking in if you can get deep in the mud. And we fought some good rips. We saved a few lives. We lost a few. But, I really enjoyed it. I enjoyed, again, the camaraderie, looking to the left and the right and knowing that you can go to war and be okay. So that was important.
And did you... Because you already talked about how a lot of firefighters have something else that they're doing at the same time. Did you, I know you worked construction, but did you start investing in real estate when you were still firefighting?
Yeah. Again, long story short, I know time is tight, but I was going through the financial crisis, really kicked me in the teeth because I did everything the way everybody else did. I was a sheep. I'll be frank with you. Right? 401ks, government pensions, do the right thing, blah, 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 blah. but I didn't have a lot of financial literacy behind me. Therefore, I was carrying a lot of unsecured credit card debt. So I'm working hours and hours and hours and hours and hours, and I'm never catching up because I'm playing the game the wrong way. And it took me to a point where I was almost losing my primary residence. I'm a man of faith, believe it or not, and I'm screaming and shouting at God one day, and I'm like, dude, I don't want to lose my house. I work hard. I was doing 3 full-time jobs at the end, about 120 hours a week, family at home, and it just sucked. It really sucked. I was working hard, not smart, and I'm screaming and shouting, my God, and he's like, nothing, silence. I was in my F-150 pickup truck. Anyway, I turned the ignition on and a commercial came over on the radio. Teach me foreclosure, a free 1.5-hour seminar coming to your neck of the woods. And I'm like, okay. And that was my road in. I was a student. I was a student in the seminar world. And I sat in a class and somebody taught me the first strategy I used, which was the wholesaling strategy, controlling a piece of real estate with a contract. And I thought to myself, that can't be legal. It can't be legal. I don't even own the house. What are you talking about? And then a guy said to me, hey, have you ever had a primary mortgage on your residence? I go, yeah. He goes, and did you get a notice within 2 weeks saying that somebody else is now servicing your mortgage? I go, yeah. He said, they sold your paper. That's all you're doing as a real estate investor, as long as you know how to do it legally, honestly, and ethically, and don't do it to hurt anybody else. Don't be a greedy pig. And, I learned those techniques, and those techniques, pole vaulted me forward. And, I was known as one of the top distressed real estate investors in my market up here in Boston during the crash. We learned to short sale properties. We learned low modifications. I ran a little clean out business as well as my construction business. I mean, I got deep, man. I'm a ground up guy. You know what I mean? And that's how I transitioned in. And that's what eventually actually got me the exposure with the TV show, was because I was good at what I was doing. So I started teaching it. And now when you're teaching it, I'm on the other side of that equation, and my influences change, right? There's 5 guys in a firehouse and we're all complaining about the same crap. But then you're in a room with 5 millionaires, and one of them was even a billionaire. Once you're in that environment, your perspective changes dramatically, and that was part of the trajectory from the fire department to be where we are today.
So how long did you specifically focus on wholesaling before, I guess, getting into the flipping world that then had a TV show with?
Look, but to be a good wholesaler, you got to be an excellent house flipper, because it's contractual. It's understanding the numbers, right? Nothing worse than a wholesaler who comes to you with garbage numbers. They don't know the construction numbers. They don't know the repair numbers. They don't know their after repair value. They're putting in offers on MLS. They've got no marketing. It's amateur hour. So for me, I was trained well and deployed the systems that were proven. So I probably spent 6 months in the wholesaling game before I locked down my first flip. And then I'm closing. Here, you ready? Today is January the 10th, 2025. And there's a check coming in the mail today for a flip, a contract that I flipped in the past 20 days, right? Mm-hmm. So I'm not going to walk away from my skill sets, right? That's just extra cash coming into the company. So you don't lose those skills. It's taking those fundamentals of underwriting and being conservative, and then transition them into a flip, a retail flip, into maybe a small multifamily, into a larger multifamily. And for me, there was a natural progression that just took off from there.
Yeah, and so now obviously you're still doing wholesaling when you can, but you're also focusing on multifamily now, right?
Yeah. So, I don't know that everybody needs to, have a trajectory in investing. Some people get very comfortable and overly proficient, I think, at one strategy. Like, I know guys have been just wholesalers, for example, in the Tampa market. I'm up in Boston, but in the Tampa market, they're flipping 50 to 100 contracts a year, 10 to 30,000 a contract. It's a solid, stable business that, they just feed off of that. But that's a job, right? Because if you don't flip a contract, if you don't flip a house, you don't make any money. So that's still trading time for money. yeah, the ROI is a little sweeter than sitting in a firehouse waiting for an overtime, but it still worked. So for me, I looked at that, and again, the influences I had around me, I started to spend time with the guys who were, up to 500 doors, multifamily investing doors, up to 10,000 doors. And I started again to elevate and learn a different strategy for real estate. So we went from the flipping of houses to owning, our first two family to a 4-unit property. I progressed that up to about 80 to 100, I think we had doors in Sanford, Maine, of all places, which is like the meth capital of Maine. And, it was some hardcore multifamily investing in those markets. I got stories that make your beard go from red to gray in a couple of minutes, man. I mean, but all of those scars from investing have a dollar value attached to them. You know what I mean? There's a lot of value in making mistakes. There's a lot of value in investing in tougher properties and tougher rental demographics, right? So anyway, we went through that phase. We liquidated out of that. Spent some time in the capital side of things, hard money lending, private money lending. COVID was an incredible awakening for me personally, because what it did was it took me out of the private lending, well, not private lending, but it took me out of the hard money lending game, because I was working with a line of credit from Wall Street, and then we were turning over multiple loans to the database of house flippers and investors that knew me and knew of my track record. So they were coming to us for capital, but COVID took us out of the game because the line of credit that we were working on was shut down. Kind of like an awakening in the sense, for me, it was, okay, I got to control the capital. If I'm going to be in this game at a higher level, if I'm going to elevate, I can't be relying on, the local bank that's too slow. I can't be relying on somebody else's line of credit. I want to be in control of that credit. And I reconnected with a friend of mine, a guy by the name of Walter Nowicki, who's about my age, been a warrior in real estate, been through a few cycles. And, we came off, I don't know, maybe 6-8 weeks into the COVID BS, and we're like, what's the play, man? What's next? And Walter said to me, he said, I've been raising capital for apartment complexes and doing what's called a repositioning. A repositioning meaning, you raise rents, you decrease expenses, maybe you do some repair work on the assets, you increase the net operating income, that increases the value of an asset. He said, I've been doing onesies, twosies. I said, do you think you could raise capital, and we'll escalate that, we'll begin to scale that up. And that's what took us where we are today. So today, there's quite a few million in assets under management. We do a lot of ground up development work now down in Southwest Florida, Cape Coral, Fort Myers. Doing it down there because I don't want to be in, no offense, Oregon. I don't want to be in Massachusetts, right? I don't want to be in the markets where, respectfully, again, to my state and yours, where I'm not welcome. I'm an investor, right? And I'm a steward of other people's capital, so I have to invest it where I know I can velocitize those investments, and those are in markets that make sense for us. So, yeah, today that's where we're at, man. I mean, I'm wrapping up a $26.5 million project, 106 doors in Cape Coral, Florida. We're looking to get into occupancy on that within the next 90 days. There's a little bit of a raise left on that one. I got a nice 16-unit property that we're doing in Rotunda West. That's about a $4.5 million project all in. That's like a 3 equity, 3x return on capital for investors on that. And we're transitioning into the pickleball business because of a set of circumstances where, you think you're falling in the doo-doo caca and you come up smelling like roses. So we're building a pickleball facility in Fort Myers. My partner's actually signing some paperwork as we speak, I think. He's in a meeting today. So, we go where it makes sense, and where I can put my investors in a position where they can 3 times their investment capital over a 3 to 5 year hold period is kind of the thesis by which we work on today. So it's a different game. I'm more in the money game than the real estate game today, which is some days that's good, some days that's boring. lot of ego in money. You know what I mean? All these swinging, whats, thinking just because they can write a fat check. So you still got to put the money somewhere that makes sense. So we're just
and
as radical.
That's an interesting transition in itself. You went from really hands-on real estate focus to the capital focus. I know you talked about COVID, drying up the line of credit and that sort of stuff, but did you ever see yourself focusing more on the capital side instead of the real estate side, which you had done for so long?
No, I didn't. Not that you don't have to be all in on just one component of it. Like the biggest kick I get is going to our job sites and seeing the progression. Seeing 100 construction workers on site, knowing that the work that we've done in the background feeds their families. That's a good feeling. I've always loved that part of it. So I still get to taste that, but in the capital raising world, I'm going to say it again, it's so ego driven, it's unbelievable. And I'm at a place in my life today where other people's opinions of me are none of my business.
Yeah.
So I don't walk in with any trepidation, fear, doubt, or insecurity, right? I go into those financial scenarios with my palms up. We always, stress test our pro formas so that if something goes in a direction that we didn't anticipate, what could it look like? Does it still work? It's a different world. And to be frank with you, my other partner is a younger gentleman. His name's Eric Wilson. He's 30 years old. He's probably the smartest human being I know. And, he lives and breathes data. He lives in that world. So when he's hanging out in the data-driven world, he comes up and I say to him, okay, show me the bottom right-hand corner of that spreadsheet. Does it make sense? And he's like, yeah. I go, okay. You trust. Again, it goes back to the firefighting, right? Looking to your left and your right and knowing that you've got massive skill set capacity around you. One of the things I learned a long time ago was don't be the smartest person in the room, because if you are, you're in the wrong room, right? Don't let that be the case. So I've learned to listen as I've got older in my career, and listening has offered me a lot of good opportunities as well, rather than walking in and talking all the time, which is what I'm doing right now.
So for this $26 million deal, obviously you had to raise capital for it. You had to place a capital in the deal.
Yeah.
How did that deal get presented to you, and what made you ultimately, I know you said you stress test underwriting and all that, but what made you ultimately want to place capital with that deal?
Yeah, look, at the end of the day, it's the market. Is it in the right market? Our studies in Southwest Florida, even with hurricanes and the challenges that market has faced, it's still got massive amount of population growth. It's got rent growth. It's got undersupplied construction. With the state of the economy as it is today, with the cost of single family housing, it's driven up the amount of renters throughout the Florida market. So number one, it's in the right market. Number two, the dirt acquisition made sense for us. I think we came in at $14,000 per door on a 106 unit build, which was a great price. That came through relationships. Again, Walter being in that market for 30 years, he knows what's up and what's not. He knows who's facing some challenges and who isn't. You can't buy that experience. That's just 30 years of grinding it out. And then we started looking at the capitalization side of it and to bring investors in. So we raised about 6 on that, put in a 19.6 loan. And, we're right there now. We've got about $1 million left in the equity raise. It's the last of the equity because we thought we could get some better pricing at the beginning, and that changes over time. That just is what it is. But those are built-in stresses into a pro forma to get you to that finish line. But even that last $1 million that's on the table right now is still looking at a 3 equity, 100,000 in, get that 100,000 back plus 200,000 over maybe a 5 to 7 year run. Still not a bad investment when you look at what's out there. And at the end of the day, where is the money sitting? It's sitting in sticks and bricks. It's tangible. You know what I mean? I always used to joke in my single family days, I love mold because I can see it, I can taste it, and I know there's value in it. You know what I mean? It's the same thing on this side. I can see the stucco finish. I can see, the work that's being done. I can, when you see the foundations going in, et cetera, et cetera. So that's why it made sense and continues to make sense in that market. And we're still aggressively buying in that market as we speak.
And now here's a word from our sponsor. Get things done while you're on the move. Learn more about working with a virtual assistant through Offsite Professionals. It's a great way to get all the things done that you need to get done, have freedom in your time, and streamline your life by automating your business. Stop spending time on the tasks that you can delegate and start spending more time on your superpower. Call us today at 503-446-3177 or visit our website at offsiteprofessionals.com.
Uptown Syndication is now offering a syndication coaching program for you to take your real estate portfolio to the next level. This is your opportunity to have experienced syndicators, AJ and Chris Shepard, coach you on your way to controlling your real estate investing future. Our coaching program will provide you with the tools and framework needed to begin syndicating real estate in your target market. Go to uptownsyndication.com today to learn more. So how does it work with you guys for on the operations side or the construction side when you are going ground up? Are you hands-on with the construction and operations as well, or do you have someone else that does that?
Yeah, so the way we structure it out is there's what's called the GP and the LP. The GP is the general partner position, which is the three of us, Freedom Venture Investments. And then what we do is Walter is in that market. Eric is doing underwriting. I'm up here in Boston raising the capital. So Walter is feet on the street in the market primarily. But what we do is we then subcontract out. We go into what's called an AIA, an architectural construction agreement. We have a national builder on this particular project. You know, they make a little extra money for managing the construction. We come in and have to put out fires. It is what it is. It's construction. It's never perfect. But there's a pyramid, if you will, of the GP at the top overseeing the operations. And where we're at today is as we move into stabilization and renting up, we're working with Hawthorne, which is a pretty prominent management company that'll manage the asset for us once we turn it over out of construction through bridge financing into permanent financing. So it's managing people rather than picking up a chop saw. I'd like to pick up a chop saw every now and again, but I think those days are done. I wasn't any good on the chop saw anyway. Don't tell anyone.
So the construction side of it, they're not necessarily in the GP stack. They're contractors
correct.
being paid for their work.
Yeah,
and then you still
correct.
maintain the GP stack. Okay.
Yeah. We maintain the GP stack, GP LP.
Yeah.
Our investors come in, fill out the equity position, the limited partner position, and then we go out and secure the construction financing to finish out the rest of the deal. So yeah, it's the employees of the company, if you will, to execute on the business plan. Yeah.
And then once you get to that stabilization period, I know you said you turn the asset over to Hawthorne to manage it. How long are you? So and then you get permanent financing on it, permanent debt on it. How long are you holding that before disposition?
Yeah, great question. So most of the ground up construction opportunities in Southwest Florida have a 3 to 5 year run for disposition and exit. Usually 2 years to build, 18 months to build, another 6-8 months to stabilize, and then work that property, work that asset for the next 3 to 5 years to maximize the net operating income so that you can exit out at those targeted numbers that you put on there at the beginning. What we are seeing now is a little softening in the market, nothing to ring alarm bells. So maybe we'll exit out at a 7-year horizon instead of a 5-year horizon.
Right.
The thing around that is our investors don't want us bailing just because we said it was 5 years and then getting out of that asset at a reduced return, right? They're intelligent investors, accredited investors who put up capital and know that we're doing 100% of the work and they're taking about 70% of the profits at the end of the day, right? So they're okay sitting in a little longer if we're sitting in the cash flow. Now, the other side of that is I might get to CO. Somebody from Wall Street shows up and says, I'll buy that at a 2.5 cap rate. And we say, okay, then we're selling now because now my investor, see ya, right? And we're still seeing that in the Florida market now. We're seeing some of the bigger players from Wall Street, some hedge fund type guys that are coming in and they still want to just, what we're seeing is insurance companies with the cost of insurance and everything. They're coming in and they're saying, okay, we need to diversify even more and get this money working so that we can make our payments that they need to make. So, they're coming in, under undercutting the market, if you will, in the sense that they'll come in at a lower capitalization rate, which is good for us, because if we're underwriting them at a 5-6 cap, if somebody comes in at a 2.5 capitalization rate, then hello, thank you, next. You know what I mean? I don't need to sit in there for an ego run. So yeah, that's how the game's played.
And when you guys, I mean, obviously you run all your underwriting. What's your projected, I guess, value at that 5-year mark on something like this?
Yeah, so this one pro forma's out. So we're all in for 26. This pro forma in out depending on the cap rate and rent increases over that 5-year period of time. But we're probably exiting out at a 35 to 37 mil on that number. So there's a nice margin in there to get things right and to also absorb things that could go wrong. So that's the projection on this one.
And I know you said there was some softening in the market. We're feeling it here. I think across the country's feeling it. Where have the cap rates gone from when you first got your eyes on this deal to, as we're talking today on January 10th, 2025?
Yeah, that delta shifted. So, when we first came into this thing, cap rates were, retail cap rates were probably around 3.5. Now they're at 5. So, if you're still buying at a 7 and your construction costs, loan of cost still comes in at a 7, that 2% cap rate margin is more than enough to get you in a strong position. So that's what we've seen. But it's going to be an interesting year. New administration, new mindset. Let's see where it goes. It's what's crazy about this stuff. Even at this scale, on the higher scale, in the millions of dollars, it's still the fundamentals. Buy it right.
Yep.
Buy it right. So many syndicators, they're called, have been wiped out of the market because they were pro forma-ing on BS numbers. Just because you saw a 7% increase in rent last year doesn't mean you can perform out 7% for the next 10 years. Year after year after year, you a-hole. That's stealing. You know what I mean? And we saw a ton of that when Biden started throwing all the COVID money into the market, and we thought we were going to see a different landscape than we saw. That just changes. So, don't get over your skis as best you can. Don't get over your skis, but don't walk away from opportunities either just because of fear. Have faith in your underwriting, and your projections are based on fundamentals. So we can take a little. We started our underwriting for our rents for this particular deal started at $1,450, I think. We've seen that rent move as much as from $1,450 to $2,100. Justifiably, based on market analysis. And now we're at like $1,980. But it's still better than $1,450 when I started. You know what I mean? But even if it softened down to $1,350, maybe it's not a 3x anymore. Maybe it's only a 2x. So the investor needs to make a decision. If it softens to that point, am I okay doubling my money in 5 years? Right? Am I okay doubling it in 7 years? So it's a case of really, really looking at that to determine whether an investor wants to put capital into these kinds of alternative assets. It's a decision, that's all. But I tell you what, the big players are doing it every single day in, day out. So I've always philosophized along those lines that there's no new and improved idea. There's no secret sauce. That's all just marketing BS. But there is fundamentals. You know what I mean? There is just good, solid business. And do as much of that as you can. You get the results.
So one question I have, just more so out of curiosity, because Oregon, Portland Metro specifically has some pretty strict rent control rules and regulations and everything like that. And so what we see here is a lot of investors or property owners, whether it's a single family or, multifamily property, we're just seeing max rent increases. If something is below market, we're hitting the max almost every single time because that's all we can do. And if we don't do that, then we get caught behind the 8 ball because we're playing catch up until that unit finally turns over. Yeah. In Florida, in this market the markets that you invest in, which are more business friendly and I guess free markets, what does a rent increase cycle look like? Is it 7%? That's what we're going to get. Is it 3% or is it 15% on a year?
3. Yeah. No, we'll do it. We'll do a 3%. So we'll pro forma out at a 3%. Look, tenants expect you to raise the rent every year. Don't disappoint them. Okay. Don't let them down. You know what I mean? This is a business. But in return for that 3% increase, you better be giving them a lifestyle that they expect, right? Quality of service in, repair service, in customer service, in, quality control throughout the complex. People, and as we go into the next phase, I think what we're also going to see is, discretionary spending is going to reduce. It's still out there right now. People are still eating steaks that they can't afford. But when that discretionary spending begins to reduce, statistically, it's shown that then, shelter is always going to be the first bill that's paid, right? No roof over your house, over your head, forget about it. So because it will focus in on shelter being number one, that'll be a little bit of a bump, I think, in rents, because it's the old supply and demand scenarios all over again. So, don't be aggressive, man. Don't be stupid with the numbers. Like we'll also lend or raise capital for other GP deals that we like. And I can't tell you how many times it goes through our underwriting process and we look at each other and we go, scumbag,
Yes.
it's not going to work. They're going to go raise the money from somebody, but it won't be from our guys. You know what I mean? Because, they're out there right now looking for fee structure rather than performance. So, just beware, But yeah, we don't go crazy on rent increases. We use a 3% standard ratio unless we've got data to support less or more, and then we'll plug that in, right? Same on the expense ratio side. So,
and then when it comes time for actually doing the rent increases, are you telling your management company, hey, we're only raising 3%, or if they feel like they can get 6-7%, are you giving them the free rein to do that?
Yeah, great question. So we all know that turnover is the biggest expense once we're stabilized, right? So we don't want to lose tenants. So, if we're in a position where, we have our quarterly meeting with the management company and they say, we're seeing, aggressive rent increases in the market, we think 4%, 4.5%, 5% is a fair rent raise at this time without, causing disruption within the cash flow. Then we'll come to again, I'm not the expert at everything, right? I manage people. So why would I hire a professional company and then ignore their advice? Yeah, I'm going to Q&A with them. I want to know why you're giving me the information you're giving me and what it's based on. But at the end of the day, if they turn around and they say, Dave, it's a 4.5 in this market all day long, then we'll go on a 4.5. If I say I want to raise it to 5%, and they go, it's not going to work. We're only seeing 3.25. We're only seeing 2.5. What am I going to do? Right? Again, my investors' capital has to be priority. That capital for my investors, they only make their money if I'm bringing in rents on the properties. So, that's the formula all the way down. Invest the capital first, service that capital the best way we know how with the right people. And, it works.
Yeah. And then I was talking to someone else the other day about this, speaking of discretionary spending, and I mean, in our market, it seems like it is kind of slowing down a little bit, just given our portfolio and the things that we've seen. And housing typically should come first, but in Oregon, where you have tenant favored laws, we see all the time people are $10,000-$15,000 behind, and then it takes us 6 months to evict them, and so they feel like they're untouchable and all these things.
Yeah.
What are your thoughts on the discretionary spending and what's causing people to, maybe not in your market specifically, but across the country, not prioritize their housing expense because of utilities going up, insurance is going up, groceries, all these other expenses that are falling on them. And, I've seen people make decisions where they could care less about their housing expense, especially here, because they know, it's going to take them 6 months to get us out.
Professional tenants, brother. Professional tenants. Been there, done that, climbed that mountain, got the t-shirt. Look, dude, learn the rules of the game from both sides of the equation. Learn the rules of the game from the investor side and learn the rules of the game from the professional tenant side. Then you make a decision where you want to invest your capital and who you want to invest it with. Yeah. I will not buy a multifamily residential unit in Massachusetts. I won't buy it. Now, I might train my 30-year-old son to get a 3-family to a 2-family to a single so that he can live rent-free. simple little strategy. You're only dealing with, 5 tenants at the end of the day. But, for a scalable business with investor capital, having potential exposure, then I'm going to go where it makes sense. I'm going to the Texas market, the Carolina market, the Florida markets. I'm going where Trumpster loves me. You know what I mean? rather than where he doesn't. That's all the politics will do today. Let's just use that common sense, though.
And then when it comes to investing out of state, I know you said you have boots on the ground in Florida, but if you're going to go to a different market, maybe you don't have boots on the ground. Are you still seriously considering investing in those markets? Yeah,
I am. But here's the advantage that I personally might have over somebody else is due to the years that we did on the TV show. That's attracted a lot of attention, right? So I know that I could pick up the phone and call a decent, solid investor who can give me guidance, relationships in pretty much any market that I wanted to invest in, right? So that's one advantage that I have. But the other thing is I might go in and co-GP in a market just to test the waters and see what's going on and how it's operated. So I might look at that strategy as well. It's not easy. Property management, construction management, good systems. That's what's going to save your ass at the end of the day.
Well, Dave, I appreciate you sharing your insights and your experiences with us. Is there anywhere that people can connect with you more after the show?
Yeah, I'm old school. We got a phone. It actually rings and somebody will answer it, God willing. 781-922-4418. We are raising on a couple of deals right now. So if you're an accredited investor and you want to look at some opportunities with us, more than happy to have a conversation with you. You can find me on LinkedIn, or you can go to info at freedomventure.com, freedomventure.com, or just hit us up on the website, www.freedomventure.com. You'll find me. I'm out there.
You're recognizable enough. Google likes you guys enough. They'll pop you up.
There you go. Google. GTS. Google that stuff, man. You'll find me.
Well, Dave, thank you so much for joining us today.
All right, brother. God bless. I appreciate you.
Thank you for listening to this episode of the Real Estate Professionals Investing Podcast on WIN, your community of investing knowledge for growth. We hope that this episode has increased your knowledge and added value to your path to freedom. If you would, please take a second to rate us so that we can get more great investors to interview. If you or someone that you know wants to be on, please visit westsideinvestors.com and fill out our form to be on the show. Thank you again and enjoy your day.